Are you worried about losing your tax deductions when you retire? I'm Sean Mullaney, financial planner. Let's discuss. There's been some old school thinking about, hey, when you're retired, you're going to have to go on the standard deduction, and that's going to be much less than those itemized deductions you had during your working years. During your working years, maybe you were deducting state income taxes, mortgage interest, some charitable contributions. And then when you retire and the mortgage is paid off and you don't have as much state income tax anymore, maybe you're going to go back to the standard deduction, and that's going to really hurt your taxes in retirement. Well, the landscape has changed. I'm going to share two major ways it has changed. Starting in 2018, the standard deduction went up significantly. Today, the standard deduction for a married couple filing joint is almost $26,000. And at age 65, each person gets another $1,400. And these numbers do generally go up most years. So it may be that being on the standard deduction in retirement is actually a pretty good tax deduction. That's also indicated by the fact that 90% of Americans today take the standard deduction and don't itemize. So it may be that during retirement, your tax deductions stay the exact same, and then once you get to age 65, you get a little increase. Then there's a second tactic that's on the table. That's for those who are age 70 and a half and above. It's called a qualified charitable distribution. This is a great little tactic where those who are charitably inclined, instead of paying out to a charity from your checking account, you call your traditional IRA custodian, or you go on their internet portal more likely, and you say, hey, take this $1,000, $2,000, don't send it to me, send it directly to the qualifying charity. What happens is there's no tax deduction. However, you get a exclusion from income even though that money came out of a taxable traditional IRA. That's really good, especially at age 72 when the taxpayer is going to have required minimum distributions. A qualified charitable distribution counts against the required minimum distribution. It's essentially a way to take an RMD and not pay tax on it. So think about it. If you're age 72, you've got the standard deduction, you've got this additional standard deduction that stands at $1,400, and say you give $6,000 every year to your church. Well, you can take the standard deduction and have the church get the $6,000 out of your IRA through a qualified charitable distribution, otherwise known as a QCD. That way, you're now getting over $30,000 in tax deductions if you're married filing joint, and that number is only going to keep rising. So it may be that for many retirees, tax deductions are going up, not down, vis-a-vis the working years. I hope you liked this video. Please like, share, and subscribe. I'll see you next time.